Yo, what's up guys, Ketal here, and welcome to another educational masterclass of mine. Today's topic is gonna be Monday range. Now, this video is gonna be shorter compared to the other masterclasses. Why? Because Monday range trading is obviously similar to range trading in Simulator. So, these same principles that you have for range trading applies also to the Monday range trading. What is the Monday range in general? Now, if you look at my chart, you can see the Monday range. If you didn't know, the Monday range is included in the Woodsbot premium indicator. So if you go to the settings on the premium indicator and you scroll down, you can see, okay, you have the Monday levels right there. You can change the colors of it a bit, so it's customizable. But yeah, basically in the Monday range, you have the Monday high and you have the Monday low. This basically is just the highest price point from the Monday and the lowest price point on Monday. This obviously resets every Monday, so every new week you have another Monday range. Today is Friday, so it's already a bit into the week. And what you can also see is the numbers on the line, so the exact number. Right now we are on the hyped chart, and you can see there it says the Monday high range got swept, as well as the low. Now, what does this mean? Basically, like in every range you trade, liquidity is the most important factor in my opinion. You've all seen this when price action is ranging, right? I'm just gonna draw something for you guys. So when price action is ranging, right, it forms a range. But what you can see here is you have a range, right? You have relatively equal highs and relatively equal lows. But what happens in a range is when you have these kinds of equal highs, price action inside a range tends to take liquidity. This means the price action What does this mean? It means if, for example, you are short in a range, right? For example, you saw, okay, here's resistance price action, we acted off this level. You are going to short here, right? So you're short here on this position and you're looking for price action to continue falling. Now, if price action then comes up, obviously where do you put your stop loss? You put your stop loss either above this high or above this high, right? This is where your invalidation is. So if price accepts above this high, well, then price action likely breaks out of this range and continues to go higher. And if you're in a short position, this is obviously bad, right? Because you're betting on prices going down. Now, if prices then comes up and goes above your level, all of these stop losses are triggered. Obviously, there's multiple people, lots of people that are shorting in the range, right? And buying in the range as well. So there are a lot of stop losses above these highs in the range, right? And if price action then comes up and triggers all of these stop losses, there is forced buying. Because if you are in a short position and your stop loss gets triggered, you are forced to buy, right? This is just how trading works. So you see an initial pump based on the triggered stop losses. And this gives the opportunity for people who want to short and keep price action into this range, get their positions filled, right? So imagine you are like a billionaire. You have $1 billion and you are struggling to find liquidity in the market to enter your position because you just can't market long into something, right? So if you see, for example, okay, you know the stop losses are above the size, and you know people are being forced to buy, well, if you want to look for shorts, there is your liquidity, right? This is where your liquidity lies. So then you can place your short orders just right above the highs where people place their stop loss orders for shorts. So people are forced to buy, and they buy into your short limit orders. And this is what you oftentimes see in a range. You see liquidations, you see a sweep of these stop losses, price is getting forced, people are being forced to buy, and then you can place your short limit order above these highs where the stop losses are from the people. You get filled on your shorts, and if you're correct on your short thesis, you have the best possible entry, right? And then price action dumps. This is what we call in trading an SFP, a swing failure pattern. And I have a real life example on how this actually looks like. So this principle applies to the Monday range as well. And if you look at it, this is what exactly what happened right here, right? So the Monday high range is basically where people put their stop loss, right? So just as I showed you guys in the example, this is where the Monday high range high is, right? So the same principle applies to the Monday range trading. You see the Monday range high was exactly right here, right? This is where the Monday range high formed. And you see how this high, this is where people put their stop loss, got swept afterwards, right? And this is basically the perfect example. If you're looking to trade a range, you obviously want to trade extremities, right? But you also need to have additional confidence. You can't just blindly short a range high or long a range low, right? And the same thing applies to the Monday range. You just can't simply blindly short the Monday high or long the Monday low. You need additional confluence. And the additional confluence in this case was the RSI divergence. So if you go to the lower time frame, you can see this is where the Monday range high formed, right? So if you go to the lower time frame, you can see this is where the Monday range high formed, right? But what you can also see is that you have actually lots of bearish divergence. You have triple bearish divergence. So, like in any range, if price action was to come into range highs, and then you had RSI bearish divergence, especially when you have triple bearish divergence on the RSI indicator on the lower time frame, well, chances are price action is gonna reject from this level, right? But what it did in this case is it not only rejected from this level, but it first swept its level, right? So people put their stop loss above this level, right? So people are short. People are short on this position. This is where their stop loss is, and maybe their entry is around this level, right? And they potentially target this Woodsbot level first, or this one, or even lower, right? Or even target the Monday range low. Now, so they have an extremely tight stop loss, and what happens is that price action sweeps stop loss, sweeps these highs, triggers stop losses. People are forced to buy, and you can see how it initially pumped, right? It initially pumped because people are forced to buy to cover their stop loss. But then you also have bearish divergence, and people are shorting this level, right? People who know about liquidity are targeting these exact positions and these exact stop losses, because people know, okay, people are actually placing their stop loss above the Monday range high or below the Monday range low, right? And people make use of this. They target these positions. People get stopped out. Price action pumps higher. You have outside bearish divergence, so you have already two confluences. And then you can see on the 4-hour candle or on the 4-hour chart, price action swept obviously the Monday range high, but it closed below. And this is what we call an SFP. And I showed you guys an example of this earlier, right? And if you have this SFP, this is a massive trigger for to short a range. And this counts for any range trading, by the way. If you see price action coming into range highs and sweeps these range highs, takes liquidity, but closes below these highs again. This is what you call an SFP. So price action tried to accept above the range high, but what it only did was sweeping these highs and then closing below. This is extremely bearish, especially if you have bearish RSI divergence. And this is the only thing you need for trading a Monday range. And the position would look like this. So if you saw, okay, it created an SFP on the Monday range. It also had bearish divergence. It swept the highs. So you put your stop loss above these highs, because price action should not come back above. It should not sweep another high, right? Because it already signaled weakness. It had bearish divergence. It SFP'd. It closed below the Monday range high again. So you have an extreme tight invalidation. Your entry is based on the 4-hour candle closure. And you target the Monday range low. And this is what you see so many times on the Monday range. You see price action sweeping these highs, potentially closing below. This is your short trigger. You target the Monday range high, Monday range low, and you target a sweep of this as well, you know. And this is where you could also potentially go long. So if price action had bullish divergence coming into this level and swept and then closed above, this could be a long entry, right? But in this case, it didn't happen. So the difference between this short position and not opening a long position here is because the 4-hour candle actually closed below the Monday range low. And here you can see it didn't close below. It just swept liquidity, but closed below the Monday range high. And here, price action needed to sweep these low and then close above the Monday range low, right? But it didn't happen. It actually closed below the Monday range low, and this is an extremely bearish signal, right? But this is basically how you trade the Monday range, or any range, so to speak. Range trading can be pretty easy. You just need to consider the RSI divergence. You need to consider liquidity, the candle formation, the SFP, and this is basically all you need. Like it's not that complicated. It can be super easy, and you can see how the Monday range low acted as resistance afterwards, right? So the 4-hour candle closed below the Monday range low, and afterwards it acted as resistance. Price action tried to reclaim, but it never really happened, right? So to recap, Monday range high, Monday range low acts as resistance and support. The best possible thing for entries is to wait for a sweep of the Monday range high and the Monday range low. Use that sweep for a potential trigger, but only if there is bearish divergence on the lower time frame. If you have that bearish divergence or bullish divergence, depending on the Monday range high or Monday range low, then you can look for longs and shorts. So look for liquidity, look for a sweep of the high and low, look for bullish and bearish divergence, and wait for the candle closure to actually sweep the high and then close above the high, below the high or above the low. And then you have an easy, nice trade setup that can print you money every fucking time. It works wonderfully. It works so good, it's so precise. And this is the best example I can show you. Alright guys, I think that's it. There's not really much else to say. Range trading can be super easy. Make sure to use the money range a lot. Make sure to get the Woodsbot indicator. Yeah, thanks for having me. Thanks for listening, and have a nice day. Have a nice day. Bye bye, guys.